Let me simplify the concept of trading for you. This entire candle represents any period of time. For example, on a daily time frame, this one candle will represent a whole day's worth of price action. At the start of the trading day, you will have an open. Price is going to have a low as well as a high, and then at the end of the trading day, price is going to close, leaving you with this candle. Your job as a trader is to try and profit within this candle, and to maximize on your profits. If you are bullish, you're going to be looking to get in on price action as low as you possibly can, because then you are going to be able to maximize on more profit, as opposed to if you got in too late around here, because price will make a high and then retrace later in the day to form a close. So you don't want to be this person here. Instead, you want to be this person down here. Now, in order to find opportunities down here, you need a couple of things. You need some form of point of interest area on a higher time frame. So that could be some form of imbalance, for example. So when price begins to open on a new day, you're going to get some form of consolidation, and then you're going to get price dropping lower. Once price drops lower, pay attention on a smaller time frame to see if price starts to shift. And if price starts shifting, creating another form of entry below the opening price that you see here during the London session or the New York session, that's giving you an opportunity to get into the market and capitalize on this big move here. SMT divergence is easily one of the most effective ways to anticipate a reversal or a change of direction in the markets. And if studied correctly, this will give you an amazing piece of confluence backing up your setup. SMT divergence is found between pairs that should correlate. So for example, Euro USD and Pound USD should move in the same direction as each other. If you find a situation where Euro USD breaks structure to the downside, having swept that high, but the same high on Pound USD has not been swept, but you see price breaking lower, that is telling you there is a crack in correlation between these pairs, because Pound USD is unwilling to go above these highs right here, as where Euro USD is willingly sweeping these highs and then shifting price to the downside. This shows signs that sells are stronger and that a reversal is likely to happen. This high on Euro USD is the exact same high as this high on Pound USD. The difference is that on Pound USD, we run above these highs and then shifted to the downside. On Euro USD, price failed to run above the highs, but still shifted to the downside. That is a cracking correlation. That is showing you that price is likely to move lower. You could be a participant in the market around these fair value gaps here, or this particular one here, with the knowledge and understanding that you have noticed a cracking correlation between pairs, giving you that extra piece of evidence that price is likely to shift in your favor. How to identify a valid order block? A bearish order block is the highest up close candle before a bearish displacement. A bullish order block is the lowest down close candle before a bullish displacement. The order block is only valid after the displacement in the opposite direction. So when you see this candle close here, you need this bearish candle to close next in order to validate this as a bearish order block. And when this bearish candle closes down here, you need this candle to give you a bullish displacement, which would then validate this as a bullish order block. If you look at this up close candle here, that's just a normal candle at the moment. But what would make this a valid order block? When you see displacement in the market. So now this is a valid bearish order block, which you can see price will mitigate into and respect. As you can see here, random candle closing bearish. We've had bullish displacement in the market, therefore making that a valid order block. And as you can see, price comes back, retests the bullish order block, pushes to the upside. Let me show you how to master entries in the most simple way possible. First thing to do, mark out the daily open, because if you are above the open, you're going to be better off looking for sells. If you're below the open, you're going to be better off looking for buys. So in this example, we can see price pushing higher. What we need is an area of interest. So I've gone to a higher time frame and I'm looking for areas of interest. You've got this order block right here. You've also got this area of imbalance. Time and price is everything, and I trade the New York session, so I want price to be in and around either this order block or this area of imbalance during the time I want to trade. So now I'm back on a smaller time frame. Price has gone into my point of interest area and aggressively dropped to the downside, but I need somewhere to enter off of, so I'm waiting for some form of order block or some form of fair value gap to take an entry off of. As you can see, price has left a really nice area of imbalance. We are inside the New York session. We have broken lower from my area of interest. We are also above the opening price, meaning sells are fully valid. So all I have to do now is set my entry, targeting liquidity below and waiting for price to play out. All I have done to find this entry is identify a point of interest on a higher time frame, identify whether I am below or above opening price, waited for the right time to trade, which for me is in the New York session, and waited for a confirmation on a lower time frame, giving me a fair value gap or an order block to sell from. If you put the work in, you will be able to learn this skill, which essentially will give you the ability to do whatever you want.